Hi Ali, how are you?
I'm good, Rana. How are you?
Good. Thank you for joining the session. We've done a session on investing before, and we got a lot of questions around mutual funds in particular, and also more about investment in in specific terms and how can we go about actioning what we've discussed. So I wanted to have someone who has expertise in this area come out and talk about it. Ali Asghar is the head of research at Al Meezan Investment, which is essentially the largest asset management company in Pakistan. He's also a chartered financial analyst. He's been in the industry for a long time, and he's someone who will, share with us his views on why we should be investing, what are the avenues for investments, and also for mutual funds in particular, what is it that we can do to have our money sort of work harder for us. So thank you for joining, Ali, and I really am glad that you took time out of, I know, a busy timeline right now with a lot going on. So thanks a lot.
No problem.
Great. So let's get right into it. Can you tell us, Ali, why you think in particular we need to be talking about investments and talking about, saving our money to be able to invest it?
Okay, so I think the first question that you asked that why anyone should be investing, it's just basically very simple maths. Like everyone wants to increase the long-term purchasing power, right?
Mm-hmm.
And let's say if you don't have, if you just keep money in your bank account idle, it's you're actually going to lose your purchasing power. So let's just do this quick maths over here. Let's say you had 100,000 rupees at the start of January 2015, and you want to see how much is that money worth today in 2020. Now you need to keep in mind that every year there's a certain percentage of inflation. So from 2015 to 2020, the average inflation rate was 6%. So if you had put this money in a current account, in a bank current account, which does not give you any rate of return, so the actual value of your money from 100,000 would actually depreciate to 74,000. So you lost out on the 26,000 because you did not invest that money anywhere. So it just you are basically just losing out on the purchasing power if you don't invest anywhere. So that's I think that's a very easy way of saying that you should invest, be it in stocks or bank deposit anywhere, but you should be investing some money.
And that's something really important to understand, right? Not investing does not mean that so our money is the same and we're not doing anything extra with it, but essentially it remains the same in a few years. That's actually not true. So where you're not growing your money, you're actually actively degrowing your money.
Yes, exactly. Yes.
Great. And if you can talk a little bit about, so investment seems to be, at least from what I'm getting in feedback from these conversations that we're doing, it seems to be daunting for people to understand, how to take that risk. So if you can talk a little bit about risk, किस तरह ascertain कर सकते हैं हम कि क्या risk appetite है हमारी, and does that differ based on how much capital I have, or how old I am, what my needs are? How does it differ?
I think for anyone who wants to invest money, they should keep in mind two things. First, you need to understand the life cycle stage in which you are. So if I can broadly categorize it, there are three investment stages that every person goes through. So the first stage is basically the accumulation stage, and let's say this is for people who are starting off their careers, and after graduation they start building on their capital. That is the accumulation stage. You're not married, you're single, your risk appetite is a lot higher, so you can invest in equities, you can uh, take on more risk with your investment options. The second stage is your maintenance stage, when you get married, you have kids, your family grows. So your risk appetite tends to narrow down and you become slightly risk averse because you are not only don't want to just increase your capital, but you also want to safeguard the capital. So you're not going to take wild bets with your capital.
You have more to
And
lose
third and
essentially, yeah.
yes. And the third and the last stage is your distribution stage, where that is your retirement stage. So basically, all whatever you have earned you just distribute it out to your family or your friends or whatever. So basically, the more investment savvy you are in the first two stages of your life, the more money you will have at the end of your career or your distribution to distribute out in the buying stage. And obviously in the retirement stage, your risk appetite is very low because you're just saving on money to meet your maybe health expenditures or meet your living expenses because you're not essentially earning in that stage of your life. And the second part to this thing is that you need to understand what is your personality type. I mean, this is just a way of categorizing what kind of an investor you are. What is your investor personality type? There's no right and wrong to this, but it just gives you a perspective. So you can either be a very cautious investor, someone who prefers safe, low volatility investments. They do not like making their own investment decisions, but they're also reluctant to take investment advice from anyone. The second type of investor is someone who's very methodological. So he would base a lot of his investments on thinking. He would gather all information and base decisions on always facts. And they're always on the lookout for better investments. The third is someone who's very individualistic. So the kind of person who's very confident in their ability to make investment decisions. They're less likely to rely on others for investment decision making. And this kind of a personality can also be overconfident at times because they don't rely on others for investment decision making. They think whatever they're doing is right, and at times it's right, and at times it can backfire. And the fourth and last investor type is someone who's very spontaneous. So these kind of individuals, they keep on changing their portfolios. One day they would be at the 100% equity and stock market, and the other day they would be like, okay, you don't want to be taking the risk of equity, so we just go into something more stable and secure, like maybe a bank deposit. So they keep on shuffling their portfolio, but what they tend to lose out in this is that whenever you shuffle your portfolio, there's a certain element of transaction cost involved. So you may think that you may be making a lot of money by moving from equity to stock or to real estate, for example, but you will be incurring the transaction cost, and that is going to pull down your returns. So these
That's
are
such
the
an
two steps.
important point, actually, Ali.
Yes,
What you
yeah.
mentioned about transaction costs, because a lot of times we're not thinking about that, right? You may think that you're being really really wise with doing that. So as soon as something is going, or you hear more about investing in one particular type of avenue, you quickly pull out of another and do that, but you don't realize that there's a transaction cost as well attached to that.
Yeah, and obviously that's part of that's part of your return. So let's say you make a 10% return, but 2% is your transaction cost. So your real return is not 10%; it's actually 8% because 2% is spent on doing the transaction actually.
And if I were to ask you, in your experience, the Pakistani investor, what kind of personality type have you seen most?
This is going to be a very general question, but I think what I see is that mostly people are spontaneous. They keep on, because to be a very long-term investor means that you stick to a certain portfolio. Let's say you decide, okay, I want to, over the next 5 years, I want to keep 20% of my portfolio in stock, maybe 40% in real estate, and 30% in a bank deposit. But someone who is very spontaneous, like people keep on, changing their portfolio. And by doing this, maybe at times, they may be making more money, but at times, if you look at the end of the 5 years, they may not be making a lot of money. So mostly, I think the Pakistani investor is very spontaneous.
Okay.
Generally speaking, I mean, it's very I can't, yeah.
Great. And if I were to, like you said, moving from one particular type of investment to another, I'm assuming, of course, that people do that because there is that either promise or potential of high returns, or they feel one particular avenue might be making a loss, or it's hearsay. Like you said, there's some of us who will believe everything that somebody else is saying and be quick to make decisions. But when we see that there is a difference in the returns that different types of investment avenues provide, what is that difference, and is that really stark?
Yeah. Okay, so if you look at basically, there are 6 or 7 broad asset classes for any investor investing in Pakistan, right? So there's the stock market, you can invest in gold, you can put your money in the defense savings certificate, you can put it in 10-year government bonds, you can buy T-bills, or you can put the money in a bank deposit. And another source of asset class, another asset class is basically real estate, but I haven't put the data in it for that because real estate is not for every investor. Not a lot of people have access to that kind of capital that is required to invest in real estate. So now if you look at this table, it basically covers data from 2002 2020, April 2020. And this shows the return over that time horizon for different asset classes. So if you look at the bottom rows, basically 19%, the KC100 delivered a return of 19% for all this, for the entire time duration. Gold was 16% and majority of the people, they put their money in bank deposits. That has given a return of around 6%. And inflation, interestingly, during this time was around 8%. Now, the important thing to note is that inflation tends to pull down your total return. So let's say the KC100 return was 19% for this period, but the inflation was 8%. So your real return is actually 11%, it's not 19%. And similarly, if you look at bank deposits, the average return was 6%, and inflation during the same time was around 8%. So that means that you generated a negative return of 2%. You didn't make any money. Actually, your capital depreciated over time.
Yeah, let's just send a sorry to everybody who invested in that. Because it is true, right? When you look at it this way, you may be happy that you made this return, but actually when you look at inflation during the same time period, it really is an eye opener. And interesting to see that it is investing in stocks that give you the highest return, right? During at least what the data tells us for the last decade.
Yeah.
So how do I access this return, right? How do I get to the stock market? How do I invest in the stock market to be able to get that amount? And also, if you can, just right before getting into that, talk a little bit about. So we're looking at this on a 10-year time period, right? If I were an investor who wants to invest for a shorter term, would I have the same direction or guidance? Would the stock market still be the preferred avenue, or would it be something else?
Okay, so I'm going to answer the first part of your question, that how does an investor get access to the stock market? Sure. Basically, there are two broad categories to which you can access the stock market. First of is directly that you open a brokerage account with the broker and you trade through that brokerage account. The second source is you invest your money through a mutual fund. Now, basically, mutual fund is basically pools money from different investors and they invest in different asset classes. Broadly speaking, equities, gold, and equities and gold, and basically bank deposits. So if you talk about why investing in mutual funds, obviously it has some advantages which far outweigh the disadvantages. And the biggest advantage of a mutual fund is that you don't need a lot of capital to invest. You can start as low as 5,000 rupees.
That's very heartening to know. That's very heartening to know that because investment doesn't mean you need to have a huge amount of money to start, right?
Yes. And now compare it with real estate. Now, to buy any small property, you would need at least maybe 20-30 lakhs to invest, right? So the capital outlay is very small. Second, you get access to the investment expertise of a team of very experienced people who have been in the market. They know how the capital markets move. Then you get certain tax benefits, which we can talk about later. And then you also get diversification, which means that your money can be spread across different industries. Like say, if you invest in the stock market, so your fund would be invested in banks, in consumer stocks, in pharmaceutical stocks, in automobile stocks. So you get exposed to a lot of other sectors which you as an individual will find it difficult to do. And another important point is liquidity, that it's as liquid as a bank account. You can invest money and you can redeem your money based on your own convenience. There is no holding period. It's not like your money is locked for a certain amount of time. you can redeem your money within I think within less than 24 hours. So that's not also a challenge. The only con to this, which I think it's not con actually, is that it's basically service fee. So you have to pay a management fee for the amount you invest. So let's say if you invest 100 rupees, you will have to pay 1.5 to 2% of that invested money as a service fee to the asset management company with which you invest.
Right.
And and the second question about time horizon, actually, it depends. It goes back to my earlier slide on what stage of life cycle you are in actually. Let's say you just started off your career and you are maybe in your high 20s, 27, in 25, in the 25 to 30 age bracket. So your time horizon is quite long, right? The average maybe age is 65, 67 for an average Pakistani male, right? So you have around 40, 45 years. So your time horizon is long, so you can take on more risk. Basically, there's a general rule that the higher the time horizon, the more risk appetite you should have, because you can recover. Let's say, it's in simple words. Let's say maybe you go very aggressive on equity in when you are in your late 20s. So you end up losing money because equity is risky. But since your time horizon is long, you can recover some of the losses by making sound investment bets in the next 10 years of your life. So
right.
it gives you more. The time horizon basically increases your risk appetite. So if you are to invest in the stock market, it's generally meant for people who are very young and who don't have a lot of responsibility, or they have that kind of a personality, and they can take on that risk. But equity generally is meant for longer term. So let's say you should have a very at least a medium to long investment horizon. I mean, if you invest money in the stock market today, you should not expect that your money is going to double tomorrow or grow by some. There's a certain waiting period for investment in stocks. And I'm talking about mutual funds, basically.
Right. And I think the case for mutual funds is strong, right? Especially for someone who's a first-time investor, or who's doing this, who's looking at all avenues, and maybe they haven't done this before, and they want something that's less aggressive, that's less risky, and it is easier, and they can leave it to someone who has more expertise in that particular area. That said, who do I approach? Like you said, you could have a team of people that could be helping you out for a certain service fee that you're paying them. Do I reach out to my bank? Do I find these companies online? What do I do?
Okay, so let's say you decide that you want to invest in a mutual fund. So how do you go about it? Basically, if you talk about Pakistan, there are around 20 asset management companies in Pakistan. An asset management company obviously have a pool of mutual funds. Meezan Investment, for example, is the oldest and the largest asset management company of Pakistan.
Yep.
So you select your investment management company based on 4 or 5 very broad principles. First of them is the management profile. You need to see that the asset management has been around for some time. It has a decent number of fund offerings, and they have a decent track record of past fund returns, and the ability to invest online. Like, you wouldn't want to go to a branch every time to invest. So these are the 4 or 5 principles point that you should keep in mind when selecting any asset manager in Pakistan. The second step is that you open an account with the asset management company. It's just like opening a bank account. So you walk and all these asset management companies, they have different branches spread all across Pakistan. So let's say we talk about Al Meezan has around 20 to 25 branches all across Pakistan. So you can go to the branch, you can open an account. And something that I see in near future is that opening an account is also going to be online. So you can just sit at home and open a mutual fund account. You don't even have to go to a branch. Like in case of when you have to open a bank account, you still have to go to the branch. So this step is also going to be eliminated, I think, very soon, inshallah. The third thing is that you need to select what kind of fund you want to invest. So now there are around 6 or 7 categories of fund, and you choose your fund based on your risk appetite. Now, there are equity funds, which is 100% equity. This is generally for people who are who are risk takers.
Yeah.
Then there are index tracker funds. These are kind of funds, they replicate a certain benchmark. Let's say KC100 index is one benchmark which has around 100 companies in it. So this is a passive style of investment. It's in easier words, it's slightly less riskier than 100% equity funds. In easier words.
Right.
Then you have balanced fund, which has a mix of equity and debt. So equity could be 60% or 50%, and remainder of the portfolio could be debt based on the allocation. Then there are commodity funds like Meezan has one of its fund is the Meezan Gold Fund, which invests in gold, and you don't have to buy physical gold. But you can get the return. The return is being derived from the price of actual gold. And then there are sector-specific funds, like say they could be energy sector funds. So if oil prices are rising for whatever reason, so these companies in the energy sector fund, they will be generally doing well, so you'll be making money on that. Then the income and money market funds are basically just like you put money in a bank deposit. So these are the most safest and the less meant for less risk-averse people. Yeah. So you need to select which fund you want to invest in based on what your risk appetite is. So now let's move on. Let's say you have invested in a mutual fund. Now what are the next few steps that you would want to take, right? I think
if I just ask a question here, Ali, before we move on.
Yeah.
So just backtracking a little bit to what you said about, opening an account and being able to visit any of the branches of the asset management firm that you've chosen and, opening up that account. Do I need to provide any evidence of income, tax filing documents, anything like that? Or maybe is that dependent on the capital size? How does that work?
Basically, you just have to go to a branch. They will give you a 6-page document. It's called the account opening form. It just has basic checklist items like they will take your proof of income, your CNIC, your postal address, basic requirements, and that is it. You don't need to give them a bunch of documents to open an account. It's very simple, and it's not as complicated as people perceive it to be.
Right.
Yeah.
Great. And so I've submitted those documents, and does my account open instantaneously, or do I get a notification? How does it work?
You submit your documents and your account will be open with the same day or maybe the next day. You will get an investment alert through a text message. You will get an investment alert through email. So just like a bank account, let's say when you make a credit or debit transaction in your bank account, you get alerts on your text through text, right? Yeah. That is how the mutual fund works. You will get an investment alert. You will be notified on emails. It's as good as a bank account.
Right. And in terms of the funds that you mentioned, these are funds that I can opt into when I'm opening up the account. Is that something that? Yeah.
So when you
go ahead.
Yeah. So when you decide, let's say you decided you want to invest in a purely equity fund. So now I'm talking about my company. My company has around 5 or 6 funds, equity funds to invest in. So the salesperson is going to tell you, okay, these are the funds that we offer. Which one of you would you like to invest? Now you can look at the past track record of that fund and then tell it's a salesperson that, okay, I want to invest in this fund. So your investment is going to be credited in that fund.
Okay, fantastic.
So basically, these are very broad. These 6 categories are broad categories, and within each category there are smaller sub funds.
Got it. Great. So moving on to once that investment fund has been chosen and I've opened up an account, what next?
So I think, as I mentioned it earlier as well, you can claim a tax rebate by investing in a mutual fund. So basically, investments in mutual funds is a tax deductible allowance. So you can submit your investment form, whatever proof that you get that you have invested in a mutual fund, and submit it to your finance or HR department, and they would lower your tax. I'm talking about salaried person, but it's also available for person who are not, who are self-employed.
Right.
So for a salaried person, you can, let's say you pay 100 rupees of 10,000 rupees of tax every month. Once you show that proof that you have invested in a mutual fund, your tax incidence is going to go down from 10,000 to, let's say, 8,000. I'm just giving hypothetical numbers. The numbers would vary, obviously. So now, so this basically leads to two sources of return. One is the source of return that you're getting from investing in the fund, and the second source of return is your lower tax income, your lower taxation. So this adds up to the total return that you make.
That's actually really gratifying because, of course, with tax rates increasing as well for someone who's salaried, knowing that you can also save on that, I think that's quite tempting as well to invest within mutual funds and to be able to also claim a tax return in the process. That's great.
Yeah. And okay, now you have invested in a fund. Now you want to see how the fund is doing, and you want to see how is your portfolio growing. So every month, these asset management companies, they issue a fund manager's report, which basically outlines the where the fund is invested, what was the return during the fund, who is managing your money, and the expense that was charged, the management fee, and the outlook of the fund going forward. So you can read up on that. It's all available on the website. You can go on the website, you can read it yourself. It's very transparent, so you know where your money is going.
So Ali, in terms of the return itself, I mean, it's great to know that it's such a transparent process and I get a monthly report of what's really happening. Can you tell me, like, in terms of the frequency of the return, what is that? Is that annual? Can I look at like monthly return? How does that work? Does that differ from fund to fund?
So the stock market return is based on the daily price movement of stock, because stocks is invested in the stock market, in the equity market, where share prices move daily. So both stock market returns are annual. Let's say if I say that you get a 20% return, that's an annual return.
Right.
So returns are, in the terminology over here, is annual.
Right.
And you have, let's say, you also, I missed this point where I think should have mentioned it, that these funds pay out a dividend as well. So let's say you buy 10 units of a fund and the fund declares a dividend at the end of the year. So your 10 units would actually increase to 12 units. And then you have an option that you can invest that additional 2 units in the fund, or you can, take that money out. You think that, okay, I want to maybe spend that 2 rupees, the 2 additional units that you got, and you can spend it, or you can reinvest in the fund.
And I can also add money to the fund. So if I see that it's doing well and next year I also have some other savings that I want to put in, can I increase?
Yeah, obviously you can, if let's say you think that the fund is doing well and you want to add more money, so you can make additional investments, and you can do it like most of the asset management companies. They have an online web portal. My company specifically has a mobile application. It's available on Android and Google Play, and you can download that application. It's just like like the internet banking application that you have on mobile. You can just download it and you can make investment. And you can also use internet banking of different banks. So let's say if you have an account in Meezan Bank, you can invest or redeem with that bank account. So the point is that you don't have to physically go to the branch every time. I think the physical appearance in the branch is when you just have to open the account. After that, it's all online. You don't have to go to the branch, or you don't need anyone else to, to make the investment for you. You can do it online sitting at home.
Great. That sounds really, really convenient. What about, we talked about obviously in a positive scenario that if I wanted to, invest additionally, what could happen? But what if for any reason I want to pull out my money? What do I do then? Is that a possibility? And you said there was like a 24 hours timeline. So how does that work?
Okay, so let's talk about how easy it is to get your money back. So redemption is not an issue. It's very liquid. For example, my company has 2 facilities for immediate liquidity needs. So one of them is like an ATM facility. You can get instant cash through Meezan Bank's ATM. Now you can instantly redeem up to 20,000 rupees per day. You can insert your debit card in any ATM machine and you can get 20,000 rupees. The second one is Meezan Easy Cash. within 30 minutes of submitting any form at any Meezan Bank's branch or Al Meezan's branch, you can withdraw up to 100,000 or 80% of your portfolio, whichever is lower per fund.
Right.
So let's say this, immediate liquidity needs can be addressed within 30 minutes in case of the easy cash facility, and with an ATM it's instantaneously, obviously. And for, let's say, for something which is bigger, let's say you want to invest redeem something more, the time frame from that is also less than 24 hours. If you make an application today, you will get the funds back in your account the next day.
That's great. No, I think it makes a lot of sense in terms of it being an easy process, and as well as the benefits that one can derive from it. So thank you for sharing that, Ali. I think it was very well put together, and hopefully it's going to help people make that decision on investing, as well as specifically investing within mutual funds. I think the fact that you are technologically capable as a company, and you've provided these solutions in terms of an application and online portal, it just makes things more transparent, more convenient, and just makes motivates one to be able to do this. So thanks a lot for that. I just wanted to, before I end, also talk to you about investing in an individual personal brand. And I wanted to ask you what your thoughts are on that, and anything in particular that you yourself are engaging in during this time when we're all kind of working from home virtually. How is it that you're doing that?
I think this is one of a very different time to be living in. Obviously I'm working from home, but so I get some time to, So if you talk about investing in yourself, you have a very good source by the name of Coursera. You can go there, you can do online courses. It's free. You don't have to pay money. There's another website I was looking at today. It was something, I'm skipping the name right now, but it's something where you can do virtual internships with any company in the world. So sitting in Pakistan, I can do a virtual internship with Citibank or with JP Morgan, with all these companies. That is something that you can add on your resume. This is generally meant for people who are starting off their careers, because anyone who is graduating in 2020 might be in a difficult situation in terms of finding a job. But this is the best time to upskill, and you can add these internships, and you can add these different courses to your resume, and make your resume more valuable when things go back to normalcy, and and improve your prospects of getting a better job.
Certainly. Well, thank you. Thanks a lot. I think that's very useful, very valuable information that you shared with us. And I really, really appreciate you taking the time out to commit to this, and to be able to share these very important, useful tips with all of us in terms of investing. Thank you. Thanks a lot.
No problem. Thank you, Anna. Thank you. Nice talking.